Is American Express's ballooning debt a strategic play for expansion or a harbinger of financial trouble? We've delved deep into their financials, uncovering eye-opening insights. From surging cardholder receivables and millennial spending habits to a surprising dip into negative cash flow, we've got the full story behind the numbers. Stay tuned to see what this means for investors. Ready? Let's get freaky in those accounting sheets. Founded in 1850, American Express operates through three main segments: Global Consumer Services, Global Commercial Services, and Global Merchant and Network Services. Beyond issuing credit and charge cards, it provides expense management and travel services. Unlike some competitors, Amex charges merchants a discount fee when cardholders make purchases, generating significant revenue. Understanding this fee-based model and its impact on profitability is crucial for investors assessing the company's financial health. Examining the balance sheet, American Express increased its cash reserves to $47.9 billion by September 2024 from $46.6 billion at the end of 2023, reflecting prudent liquidity management. This bolsters their targeted common equity. Tier 1 capital ratio of 10 to 11% essential under the stricter regulations of a Category 3 bank holding company. However, total debt rose to $55 billion, raising the debt-to-equity ratio to 1.9. While higher leverage can amplify returns, it also increases financial risk if not managed properly. The company's ongoing stock buybacks and dividends suggest confidence but warrant careful attention to balance sheet strength. Here's a screenshot of the full balance sheet. Noteworthy is the increase in card member receivables to $58.9 billion, outpacing liabilities growth. This could indicate effective customer acquisition and retention, yet careful monitoring of credit risk is needed to sustain healthy margins. American Express excels in preferred stock management, outperforming 98% of its industry and 99% of the S&P 500. However, its low scores in debt-to-equity and cash-minus debt indicate significant leverage concerns. Retained earnings to market cap are average, suggesting moderate reinvestment compared to peers. American Express's income statement shows both strengths and areas to watch. The gross margin dipped to 56.5%, but operating income margin remains robust at 26.1%. Net income margin at 15.1% is solid, though EPS growth flattened at 0%. Notably, management's cost control efforts led to expenses rising only 5% against 8% revenue growth, enhancing profitability. The 18% increase in net card fees from strong card acquisitions bodes well for future revenue streams. These factors suggest operational efficiency and growth potential, important considerations for value investors. Here's a screenshot of the full income statement. A noteworthy aspect is the 8% increase in total revenues, outpacing the 7% rise in expenses, which highlights operational efficiency. Provisions for credit losses rose 10%, a factor to monitor for potential risks. American Express shows strong operating income margins, outperforming over 70% of the S&P 500, indicating efficient core operations. However, its SG&A margin is comparatively weak against the index, suggesting higher operating expenses. While profitability is solid, there is room to enhance cost efficiency and drive EPS growth. American Express saw its revenue drop to $16.64 billion in Q3 2024 from $18.4 billion in Q2, with net income decreasing to $2.51 billion from $3.02 billion. Despite this, management remains optimistic, highlighting increased spending by Millennials and Gen-Z consumers. As these younger groups gain more financial influence, their spending habits could boost future earnings. Investors might consider how this demographic shift could offset recent declines, potentially positioning American Express for growth despite short-term revenue fluctuations. Examining American Express's cash flow statement, we notice that operating cash flow decreased to negative $2.27 billion in the last quarter, primarily due to reduced net booked liabilities and timing differences in cash movements. This led to a free cash flow yield of minus 1.0%. While a negative yield is concerning, it's worth noting the company's strong historical cash generation. As they enhance operational efficiencies to adapt to market trends, we can anticipate a rebound in cash flows. For value investors, this suggests potential for recovery in the company's underlying cash-generating capabilities. Here's a screenshot of the full cash flow statement. Notably, cash from operating activities remained solid at $8.27 billion, reflecting strong core operations. However, net cash used in investing activities raises concerns, emphasizing potential risks in asset management, which value investors should monitor closely. American Express reported record revenues of $66 billion. In 2024, a 10% increase when adjusted for currency fluctuations, surpassing their growth goals. This strong revenue, along with a 25% rise in earnings per share to $14.01, signals robust financial health. The company added 13 million new card members, highlighting successful engagement strategies, especially with Millennials and Gen-Z consumers. Management did note risks like economic uncertainties and a strong US dollar, which can affect international earnings. However, expanding into international small and medium-sized enterprises and holding a 25% market share in the US premium card segment presents significant growth opportunities. These factors are crucial when assessing American Express's future potential. Analysts estimate that by 2028, American Express may reach a net income of approximately $15.25 billion, with earnings per share nearing $20.73. These projections indicate confidence in sustained revenue growth and effective strategies targeting evolving consumer behaviors. However, potential economic headwinds could impact these outcomes. Value investors should consider whether these growth expectations are attainable and how they compare with competitors. American Express's net income and EPS scores surpass only 30% of industry peers and about 49% of the S&P 500. This suggests the company is underperforming in these profitability metrics compared to competitors, which may be a concern for value investors. American Express's PE ratio of 16.44 suggests potential undervaluation compared to Visa at 22.57 and PayPal at 21.18. A lower PE may indicate a good value opportunity. Its PB ratio of 4.91 is higher than Capital One's 0.86, but lower than Visa's 11.39, reflecting how much investors pay for each dollar of the company's net assets. Management emphasizes intrinsic value and a unique business model, aiming to provide stability amid market fluctuations in the payments sector. American Express's PE score outperforms 55% of its industry and 73% of the S&P 500, indicating a favorable earnings valuation. However, its PB score is lower, surpassing only 33% of peers, suggesting a higher price relative to book value compared to the industry. American Express's discounted cash flow valuation projects its share price to reach $374.58 by 2028, indicating strong operational performance ahead. However, the company's significant total debt of $49.16 billion poses leveraging challenges. Despite this, sustainable revenue and free cash flow growth are anticipated, supported by prudent fiscal policies and effective capital expenditure management. This suggests American Express is balancing growth with caution. For value investors, understanding how debt affects future cash flows is crucial, and comparing these metrics with competitors can offer deeper insights into the company's financial health. American Express's proprietary DCF score is 57.6 against industry peers, outperforming over half of them. Notably, with a 70.7 score against the S&P 500, it indicates a strong intrinsic value relative to the broader market. Analyst Forecast project American Express's stock rising from $80 in 2020 to over $300 by March 2025, highlighting effective management strategies. This significant growth suggests potential value, but evaluating price-to-earnings ratios and comparing with competitors is essential to assess investment soundness. American Express scores low on our proprietary analyst target metric, outperforming just 16.2% of its industry peers and 5.2% of the S&P 500. This suggests that analysts have limited optimism about its future growth, which may be a concern for potential investors. In conclusion, American Express's rising debt seems to be a calculated gamble aimed at propelling growth, evidenced by record revenues and robust card member acquisitions, particularly among Millennials and Gen-Z. The increased leverage, raising the debt-to-equity ratio to 1.9, could amplify returns but also escalates financial risk, especially with negative operating cash flow and higher provisions for credit losses. Valuation metrics suggest potential undervaluation, yet underperforming profitability scores compared to peers cannot be overlooked. For value investors, the critical assessment is whether this debt-fueled strategy will yield sustainable growth, or if it harbors financial instability that could undermine future performance. Make sure to watch another video from our Value Explorer series by clicking the playlist below.